The committee members will all have opening statements, and I asked them to submit them for the record. I'd like to take a moment and explain the timing lights, just so as we're going along. Green, you're fine. Yellow means talk faster. Red, please stop. We will actually be handing out 5 minutes of testimony time, and then we'll actually just engage in discussions. As typical, I have my written opening statement, but want to, just for expediency, there's probably no hearing I've looked forward more to than this one. Having met 3 of you, having read all your successes and your bios, you're an interesting group. And I believe you're doing really special things for our economic future, the economy, but also where does technology take us and give us opportunities to actually give everyone, sort of that fighting chance to be able to participate in taking a risk, but also receiving the rewards for that risk. And each of you have carved out sort of special, unique spots out there. As you're doing your testimony, as we're also engaging in the questions, it's not only telling your story, but share with us where government has done things that work, but also where our regulatory environment and those of us in Congress either didn't understand or we've created blocks, statutorily, regulatorily, on where you think you could take sort of this egalitarian access to capital. Because that's what this is really about. It's really about helping that small business, those sort of small entrepreneurs that want to move and grow and provide jobs and help all of us in this society and economy. Ranking Member Clark.
Thank you, Mr. Chairman, and I thank all of our witnesses for being here today. And I think you've really set the tone for today's hearing. For the past 2 years, our nation's economy has experienced positive and steady private sector job growth, adding about 4.8 million jobs during that time. However, these gains have not been enough to overcome our nation's above average unemployment, which currently stands at 7.5%, minority unemployment for African Americans and Latinos, while retreating remains at 13.2% and 9% respectively. So while we're moving in a positive direction, we still face challenges in fully putting America back to work. Creating nearly 2/3 of all new jobs, our small businesses must remain front and center to our recovery. For our national economy to experience a more robust recovery, our entrepreneurs and small businesses must play their traditional job-creating role, and for that, they must have access to capital. 4 years after the financial crisis effectively froze the credit markets, entrepreneurs and small businesses are still facing challenges acquiring funding through traditional avenues. Increasingly, entrepreneurs are turning to crowdfunding and other innovative funding methods to finance their ventures. These include using the internet to reach accredited investors, creating peer-to-peer lending platforms, and applying old lending models in new ways to address the issue. Congress passed the Jumpstart Our Business Startups or JOBS Act in 2012 to overhaul SEC restrictions on crowdfunding and small public stock offerings. Once the SEC publishes final rules, this law has the potential to unlock an untapped network of millions of investors to small businesses and entrepreneurs seeking capital. The SEC has faced challenges in the past balancing capital raising needs of small businesses with the need to protect investors with limited wealth and financial market knowledge. They are now in a difficult position of creating the framework for a new finance regime that has the potential to be easily exploited without proper oversight and regulation. It is important that the SEC work quickly, though not hastily, to finalize crowdfunding rules. Rushing to publish rules could overexpose investors or lead to an unworkable system that shuns market participants. In today's hearing, we will discuss the new and innovative ways small businesses are raising capital and how implementation of the JOBS Act will affect lending to and investment in our job creators. While the outcome remains uncertain, we must remember that it is vitally important that the SEC strike the appropriate balance between investor protection and producing a functional system that provides the capital for small businesses. So I look forward to all of your testimony here today, and I thank you for your insights. And I yield back, Mr. Chairman.
Thank you, Ranking Member Clark. I was going to ask Mr. Shabbat to introduce Ms. Sullivan.
Thank you very much, Mr. Chairman. I appreciate that. And today I'm honored to introduce Michelle Sullivan, who is the Senior Director of Communications and External Affairs at the Boston Beer Company. Now, I don't represent Boston. I represent Cincinnati, but the Boston Beer Company is actually in Cincinnati. I know it's a little confusing, but Ms. Sullivan is here to discuss the brewery's signature philanthropic effort, and that's Samuel Adams Brewing the American Dream. She worked hand in hand with Sam Adams' founder, Jim Cook, to engineer this innovative approach to small business lending and development. As her testimony this morning demonstrates, their program really does work. The City of Cincinnati has a rich history of craft breweries dating back to the pre-Prohibition era. In the mid-90s, the Boston Beer Company moved to Cincinnati and breathed life into one of those breweries, which still operates today very successfully, I might add. A craft beer renaissance is taking place in hometowns like mine back in Cincinnati, but really all over America. And we have entrepreneurs such as Jim Cook to thank for that. And with his innovative approach to micro-lending, Jim continues to give back to all of our communities. Ms. Sullivan, I thank you for participating in this hearing, and as we have discussed and as you've seen, we actually have a Sam Adams barrel top hanging in our office, and on there it indicates the distance between our Washington office and the brewery back in Cincinnati. I've actually got another hearing, a judiciary hearing, which has just started also, and I have to go over there. So if I could, Mr. Chairman, I'm going to go ahead and ask you my question now, which you can take later on to answer. But it's not every day that we hear about the kind of unique effort that your company has made. And so I'd just like if you could at some point discuss what was the inspiration behind the Sam Adams Brewing for America program. Again, I thank you very much for your testimony here this morning. And Adam Scheidler from my office is here. We will get your transcript and read that as well as your answer to the question. And thank you, the other members of the panel, for being here as well. And thank you, Mr. Chairman.
Thank you, Mr. Shabbat. Ms. Sullivan, 5 minutes.
Thank you very much for your kind words, Congressman Shabbat. Chairman Schweikert, Ranking Member Clark, and other members of the committee, thank you so much for inviting me here this morning to discuss Samuel Adams Brewing the American Dream on behalf of our founder, Jim Cook. My name is Michelle Sullivan, as the Congressman said, and as Senior Director of Corporate Communications and External Affairs, I'm charged with Jim for the implementation of this innovative program. I'm pleased to be here to discuss that innovative way in which we assist small businesses by affording them access to capital and knowledge to start or grow their businesses. In 1984, when Jim Cook started the Boston Beer Company, the odds were stacked against him. Flavorful, high-quality craft beer, like Jim's, were virtually unheard of by anyone: beer drinkers, beer distributors, beer retailers, and certainly not bank lenders. After brewing the first batch of beer in his kitchen, he named it after one of his favorite Revolutionary War patriots, Samuel Adams. And after trying to obtain a bank loan from numerous banks, he quickly realized the reality of starting a small business went far beyond having a great product. Namely, a lack of access to capital and the right network of business contacts could prevent a small business from succeeding despite the quality of its product. Jim began selling his beer, bar to bar himself in Boston, having had to start his own distribution company in addition to his brewery because all of the wholesalers in Boston turned him down for the opportunity to carry Samuel Adams. He scraped together the funding for his brewery by risking everything personally, taking out a second mortgage, and by raising money from family and friends. The beer industry has undergone profound changes since those days in the 80s. America's big three breweries, Anheuser-Busch, Miller, and Coors, have been acquired or merged into foreign conglomerates, and indeed Miller and Coors have merged their operations in the U.S. So this leaves the brewery that Jim started in his kitchen, Samuel Adams, as one of the nation's largest American-owned breweries today. But after nearly 30 years of significant growth, we still only account for just under 1% of the entire beer industry. And the two largest players account for over 80%. So in the beer industry, it is still very much a David and Goliath world. That said, we are proud to continue to lead America's brewing community, comprised of more than 2,400 other small brewers in all 50 states, not only in brewing outstanding products and creating jobs, but also in our unconventional path to corporate citizenship. In 2008, working with a team of employees led by Jim himself, we created Samuel Adams Brewing the American Dream. The program has two major components. We host a variety of mentoring and coaching events for low and moderate income entrepreneurs, and through our nonprofit partner Accion, we fund microloans ranging from as little as $500 up to $25,000. Our program serves business owners in the food and beverage industries, including craft brewers, the very industry where we compete and sell in, and the one where we are most able to give those small business owners meaningful nuts and bolts advice, guidance, and introductions. Microloans are a critical component of the program. As you know, there is a serious lack of funding available today to small businesses. It is equally important to educate inexperienced business owners in the areas of sales, graphic design, purchasing, marketing, hiring, distribution, and other aspects of business that can make the difference between success and failure. And we know it works because we have a 97% payment rate on our microloans. As of today, we have dispersed 234 loans totaling over $2 million, have hosted 45 events nationwide that have attracted more than 3,000 attendees. More than 300 of our Samuel Adams employees have participated in these events as coaches and mentors. And we have saved or created more than 1,400 jobs. So in an odd twist, we've actually created more jobs outside of the Boston Beer Company than inside, and we are proud of that. When Jim started Boston Beer, he was armed with a great product, the financial backing of family and friends, and a passion to succeed. What he didn't have, and the reason he feels so strongly about brewing the American dream, were mentors. Jim didn't have a network of established business owners whose expertise he could call on. Through this program, he makes what he needed that wasn't available to him available to others, namely funding, nuts and bolts advice, and access to mentors. Working with these small business owners is an honor. We are convinced that well-supported small businesses are poised to grow and thrive. They are the engine for future economic growth. They are a source of innovation. They will create jobs. They will be the household names of the next generation. And like Jim Cook, they will realize their American dream. I want to thank the subcommittee for allowing me this chance to discuss Samuel Adams Brewing the American Dream. And please let me know if you believe our program can be beneficial in your district. Thank you again, and I'm pleased to answer any questions that the committee may have.
Thank you, Ms. Sullivan. Ms. Clark.
Thank you, Mr. Chairman. I have the distinct honor and privilege of introducing Mr. Alejandro Cremades. He is co-founder and CEO of Rock the Post, one of the leading investment crowdfunding platforms for startups in the United States. After 1 year of development, his team was able to launch the platform to the public on November 23rd, 2011. In less than a year, the platform was already mentioned by Time magazine as one of the best crowdfunding platforms in the world, as one of the top 10 digital tools for entrepreneurs by Forbes, and is one of the hottest startups to watch by Business Insider. Prior to Rock the Post, Mr. Cremades worked as a lawyer at King & Spalding, where he was involved in one of the biggest investment arbitration cases in history. Mr. Cremades guest lectures on crowdfunding and entrepreneurship at NYU Stern Business School and at the Wharton Business School. And I want to thank you for being here today, and we look forward to your testimony.
Thank you, Ranking Member Clark. 5 minutes, and help us, let's get our pronunciation of your last name proper. Well, how should we be saying it?
It's Cremades, but either way is fine. I'm used to it. So it's okay. All right, well, thank you so much for the kind introduction, Mr. Chairman and other members here present today. I am particularly interested in sharing my thoughts and experience with regard to the difference that crowdfunding is already having at its early stage on small businesses in the United States. and the positive impact that services like Rock the Post provides. According to a Kaufman report, new firms add an average of 3 million jobs in their first year, while older companies lose 1 million jobs annually. Unfortunately, 65% of the new firms go out of business within the first 4 years due mainly to lack of access to capital. Traditional methods of financing are very limited. Out of 6 million businesses that launch every year in the U.S., only 400 of them get venture capital money. The rest rely on angel investors, which represents less than 1% of the U.S. population, or friends and family. With equity crowdfunding offered via services like Rock the Post, startups are able to gain exposure in front of thousands of investors, obviously right now accredited investors. In the offline world, startups take on average 8 months to close a seed round. Via Rock the Post, startups and small businesses fundraise their round between 60 or 90 days with minimal roadshow distractions. Success stories like Billy Custom Bicycles, a Shark Tank-backed company with high-profile investors like Mark Cuban and Barbara Corcoran, raised their funding goal in just 2 weeks alone on our platform. Music FM in little over a month. Rock the Post crowdfunding platform not only help entrepreneurs to gain access to funding, but also reduces the fundraising time significantly, which allows them to focus on growing their business, which is the most critical factor for the bottom line. However, we are operating under a lot of restrictions, which makes it challenging to truly innovate and pioneer this new industry. The general public solicitation rule is the most difficult challenge to overcome. Secondly, the fact that only accredited investors are allowed to make investments is also a big obstacle. Even though the law allows up to 34 unaccredited investors per offering, we feel that the amount of disclosures required to comply with this exemption kills the attractiveness for platforms like Rock the Post to be able to get involved. Not to mention the burden entrepreneurs are faced with in providing additional disclosure materials. Allowing non-accredited investors to partake in private offerings will open the door to over 300 million Americans in comparison to the 7 million accredited people that have access to use Rock the Post today as investors. With that being said, I believe that we are far behind, and every day that passes by without the Jobs Act being implemented is another day that startups need to fight for survival. Pandora, the online radio, for example, which I'm sure many of you have heard, was rejected over 300 times from financial institutions, and thank God they did not give up on their business. I invite you all present in this room here today to create a unified voice in order to reduce the delay of the Jobs Act implementation. There are many cases like Pandora out there, and unfortunately many of them end up giving up in the process. Thank you all for listening, and I will be more than happy to answer any questions that the members might have.
I truly appreciate that opening statement. Ben Miller is co-founder of Fundrise, a real estate-based development company based right here in the Washington, D.C. area. Ben is co-founder of Fundrise with his brother Daniel as a way to involve members of the community in real estate development. In addition to co-founder of Fundrise, Ben also serves as managing partner of Westmill Capital and president of Western Development Corporation. And you went to what, University of Pennsylvania? Ben, 5 minutes.
So I deeply appreciate the opportunity you've given me. So my name is Ben Miller, and I co-founded a company called Fundrise. And what Fundrise does is crowdfunds real equity into real estate. And so we're actually technically equity crowdfunding today, 10 blocks from here on 8th Street Northeast. So any resident of Washington, D.C., you can be accredited or unaccredited, can invest at $100 a share online through Fundrise right now. And so I think that the reason I was invited is that I have, we're actually equity crowdfunding. We're doing it now. We have a good sense of what it means and what it took to do it in the current regulatory environment. And it was, obviously, there were some challenges. So I'll quickly tell sort of how we did it and what we learned. So briefly, my background is real estate development, built a lot of large-scale, multi-$100 million properties in the D.C. metro area, like Gallery Place and 7th and H. So, but the problem is institutional capital doesn't understand emerging neighborhoods. I have Mass Mutual, Cornerstone, Angelo Gordon, AFL-CIO as our equity partners. But if you look at Brooklyn, Bushwick, LA Arts District, 8th Street Northeast, all across the country, these emerging neighborhoods really don't get the attention of institutional capital, even though that's really where the growth is, especially from the millennial generation. And so we decided to raise money from people instead of institutional capital and sort of reconnect this disconnect in real estate. To do that, that was very challenging. We actually ended up hiring former Deputy Director of the SEC to help us navigate through the SEC and the local regulators to figure out how do you equity crowdfund with the existing regulations. We did that using something called Regulation A. Regulation A, I think we were one of only 2 or 3 people last year who cleared the SEC using Regulation A, and we raised $350,000 from 175 people, and it took us about 3 months to do that online. We have an offering live today. I think we had $250,000 in a few days on the next public offering. So you can see how quickly, once you start doing it, people want to do it. And I watched family and friends and wives start to do follow-on investments from the first offering. So it took us, the offering took us 9 months to get through the SEC. Cost us far and above $100,000. And the final offering was hundreds of pages and actually weighed 12 pounds. And we've done multiple Regulation A offerings now, and so I have a good sense of what it is. And I sort of say that I was lucky to have good local regulators in Washington, D.C. and Virginia, because the process was very ad hoc. They were really looking at me. This was a novel idea, selling shares of a real estate property, never really been done online before. And so I was lucky that I worked with them, but if I hadn't had the depth of resources and the staying power, I don't think that would have been possible for most small businesses, most community development organizations. And so I would say that sort of basic takeaways that you can invest in a Japanese manufacturing company today, but you really can't invest in your own community. There's no feasible way other than what I'm doing for communities to invest in themselves. And I've seen, we're now operating in, we're in LA, we're in New York actually, working with 3rd Ward in Brooklyn. Kresge Foundation just gave us a grant to launch in Detroit. So we're seeing a lot of communities wanting to reinvest in building their own communities, not looking for some outside sort of Wall Street capital to solve their problems. But I would say sort of my 2 big takeaways from doing this are, one, that I understand that there need to be safeguards for investor protections, but I've found personally putting offerings out there publicly, generally soliciting because we filed with the SEC and letting anybody invest, the public was a very tough critic. I mean, I had hundreds of questions from the SEC, and I got thousands of questions from the public. And I have real estate analysts from the largest companies in the country invested in our deals, underwriting them, asking us questions. And so I found, at least personally, that the public was sophisticated. There wasn't willy-nilly, funding of investments online. I mean, they were really asking tough questions and wanted to understand what they were investing in. And the second, really, the big takeaway I found was that the SEC and the local regulators really weren't designed to do what I did. This idea of small capital formation is not their primary mandate. They didn't have the staffing, I think, and the funding to really do that. And I think that we should, if possible, maybe the private sector and public sector come together and look at funding the institutional supports that could make maybe that possible, or better fund the institutional, let's say, institutional staffing that Small Business Administration maybe would normally do for a sector. Thank you.
Thanks, Mr. Miller. Our last witness is Ms. Ringelman. She is the co-founder of a crowdfunding portal, Indiegogo. Through Indiegogo, businesses, individuals, small organizations are able to fund or raise funds through donation-based crowdfunding. Prior to co-founding Indiegogo in 2007, Ms. Ringelman worked in finance as a securities analyst with Cohen & Company. Diane, I always get this wrong.
Danae.
Danae.
No problem. Rhymes with
Danae,
Renee.
yeah. Rhymes with?
Renee.
Okay. Danae holds an MBA from the Haas School of Business and a BA from the University of North Carolina. And I'll disclose she also runs one of my favorite sites. So.
Thanks. Well, happy to be here, everybody. Thanks for having me. Yes, my name's Danae Ringelman. I'm one of the founders of Indiegogo. We are the largest and oldest global perks-based crowdfunding platform. We do not limit our platform to any geography or industry, so we are in every country of the world and every industry. So everybody from the arts, like filmmakers and musicians, to charities and nonprofits can use Indiegogo, to entrepreneurs and small businesses, which is why I'm here today. We're also distributing millions of dollars every single week now to campaign owners across the world, so it's working. I'm talking here today, though, about Indiegogo's meritocratic approach to crowdfunding and perks-based crowdfunding, as well as what we think the benefits, the larger benefits beyond money, are to both small businesses here in America as well as the greater economy. But first, as a way of background, I wanted to introduce myself and talk about how I came to this. I actually met my co-founders back in 2006. We came together before the word crowdfunding even existed in our vernacular, out of a mutual frustration for how unfair and inefficient fundraising was. I myself am a daughter of two small business owners who struggled for 30 years to keep their business going and get a loan, and not once could they actually get a loan despite growth. Why? They didn't know the right people. They didn't have the right connections. So when I graduated college, I went into finance to understand how this world actually worked, and I actually met failure myself. I started working with some theater producers and filmmakers on the side, trying to help them raise money the old-fashioned way, and I had this culminating moment where I failed in securing investment for a theater production despite audience engagement and response and enthusiasm for this production to get off the ground. And it was in that moment that I realized that the people who wanted this play to come to life the most, which were the actors and the audience, didn't actually have the power to make it happen. They were relying on a third-party gatekeeper who had different interests. So at that moment, I said, all right, here's my new life. I'm going to quit finance, and I'm going to go back to business school and start a company that was going to democratize financing. And that's where I met my co-founders, Eric and Slava, who themselves had faced frustrating challenges with fundraising, Slava for raising money for cancer research and Eric for the arts. And together we started and created Indiegogo, which is now empowering millions of people across the world to fund what matters to them. So specifically with perks-based crowdfunding, it's a little different. The way it works is you create a campaign page on our site. You set a funding target, you set a funding goal, a funding deadline, you put up a video, and then you share it with everybody that you know. The reason why crowdfunding is different than online fundraising, though, is that Indiegogo offers extra amplification through social media integration, as well as through our GoGo Factor promotion, to allow you to reach more audiences beyond your inner circle, to your second and third order friends as well as strangers. I can talk a little bit more about GoGo Factor a little bit later. So you might wonder, well, why are people funding if they can't get equity, if they can't invest, if they're just getting a perk? And our research has actually found that there's 4 reasons that people fund. We call them the 4 Ps. People want to support the people or team behind a project. Their passion, they want to support the passion or project itself. The third reason is participation. They want to be part of something bigger than themselves. And the fourth reason is the perk. And we find that typically people fund for a dynamic number of reasons, so a cross-section of the 4 at any given time. For example, I recently funded a campaign for an app called Not Buying It. It's an app where you can take a picture of a piece of sexist media out in the world and upload it to Twitter. And if everyone's uploading it, it creates pressure for the advertisers to change their media. The reason I funded it is for all 4 reasons. I supported the project owner, Jennifer Siebel-Newsome. I supported the project. I supported the movement to stop the objectification of women or sexism in the media, as well as I wanted the perk itself. So a lot of people think crowdfunding is about just money. It's a new and alternative form of financing. But there's actually a lot more to it than that. And there's people who actually use crowdfunding not just for the money, but for the other benefits. Specifically for small businesses, there's 4 benefits. There's market validation, there's risk mitigation, there's customer feedback, and there's confidence building that happens. With market validation, what's happening is that people are voting with their dollar. And so it's a far better indicator of interest than any focus group or Facebook like button could do. With risk mitigation, a lot lot of product designers and entrepreneurs are using crowdfunding as a way to mitigate the risk of overproduction or underproduction of their first run of product, because what they're doing is they're offering their perk in exchange for funding, and therefore they fund and make the exact amount of product that they need to do to get off the ground. The third reason is customer feedback. We had a campaign owner by the name of Sunny Vu who had created a activity tracker, and he had actually raised money from venture, but he still used crowdfunding as a way to get off the ground, because he wanted to become smarter faster. He used the crowdfunding as a way to test his pricing and his messaging and his actual features, and learned that people wanted a certain color of his device more than another color, and they were willing to pay actually more for it, all through the crowdfunding campaign. The third reason is, or the fourth reason is confidence. One of my favorite reasons I think that people use crowdfunding, and that's a great example of this is Karen, who started a bakery business called Free Bread. It was her first business. She lacked the confidence to get going, and so she created a campaign to raise $10,000 to launch her bakery business, and she knew that if she failed, she'd be back in the same place that she was before, because it was always a dream of hers to start this business. And within a few weeks, she had the money, and she sent us a note saying, you know, when this started to happen, I started to raise the money. My life actually started to change. So there's lots of reasons. On the economy side and the greater kind of financial industry side, there's also benefits. The first is meritocracy. Like the other panelists said, that when every day ideas go unborn, every day ideas die because of undercapitalized, because of the lack of efficient access to capital. And so crowdfunding is making it efficient, and thereby creating this incubation platform for traditional investors to actually discover product and businesses based on their own true merit. And so that's what I think is the greater benefits, and I'm happy to go further into that. The third benefit there is jobs, of course, and I'll end there so that we have time for questions.
And thanks, Danae. And you had said you would probably go long, so.
Yes, I did.
Okay, and as chair, I'm going to give myself 5 minutes, but we'll also, this is one of those moments where I could probably grab all of you for hours, because this is an area I have great interest in. I want to start with Mr. Miller. You and I have had the conversation. Technically, you're not doing crowdfunding as we saw it in the Jobs Act. You're right now having to use the Reg A mechanics and do SEC filings, and you can also only take non-accredited investors within the jurisdiction, so within the state or D.C. area that have given you approval. Tell me how much paperwork goes with these filings. Tell me what limitations you're having to operate under right now.
Well, so there's a lot of paperwork. I mean, the good news is that we've now done it a number of times, and we're focused on real estate. So we have real estate as a product has a lot of similarity building by building, a lot of the same risk factors. I know that a normal public company like Facebook, it took them 3 months to go public, and I know it took us 9. And we raised, I think, $350,000 in this time. Now we're raising another $325,000 for another property, and I think most public companies raise billions. So it feels like there's an asymmetry there that the Jobs Act can help address. In terms of I understand why there's the paperwork is actually less a challenge in terms of, I think that there's just I don't think that there's anybody inside the SEC who really has the mandate for Regulation A. I mean, it was really underused, and I'm going to bet you that that same sort of problem will happen when you start seeing, potentially thousands of other small issuers raising money, and so that's going to require staffing up an organizational focus. And a lot of times I'll have a comment in from the SEC. The comment will be, something pretty small, or something about maybe, what does this footnote mean on the account, and it'll take like weeks really to hear back about a footnote in an audit statement.
How many pages of paperwork were in your first filing?
Something like 350 pages, a lot. But you go back and forth. Ultimately, a filing is really an iterative process, and so probably, it was a lot of disclosure.
Okay, Mr. Kermatis, you in your testimony or your opening statement were actually having the discussion of a couple things. One, right now, you can only have accredited investors participate, so it's only a small fraction of our nation's population. How different do you think your world would look if we actually had the Jobs Act, actually with the SEC rule sets done, where not unaccredited could start to participate? And what difference do you think that makes in how you would run your shop?
Well, that will make a huge difference, because right now we're restricted just to a certain amount of people in the U.S., and our platform is kind of like closed doors, so you cannot really have access to any offering or any terms on any offering unless you're an accredited investor. Once the Jobs Act is implemented, then we have the possibility of being able, especially when the general solicitation rule is revised, we have the possibility of converting Facebook likes or tweet shares into investors, really, And instead of having really that limitation towards 7 million people, really, we can access over 300 million Americans. And there's going to be different layers of investors. Obviously, you have the high net worth individuals, which are considered angel investors today, people that are making over $200,000 on salary or have $1 million in assets, or that are making with their spouse $300,000 combined. But then you're going to have the other two different types of investors, which is one, the one that is making over $100,000. The Jobs Act establishes a limitation there of 10%, where they can invest only 10% of their income. So it's not like, like in the casinos, for example, here in the U.S., people are spending $45 billion without any type of limitation. So also the other different type of investor that we're going to have is the one that is making under $100,000, and that the profile of investor is going to have a limitation of 5% of their income. So it's obviously a huge impact what is going to happen when the Jobs Act is implemented.
Okay, Danae, just off the side of this, we've had a conversation, and I've tried to share this actually very publicly, that I believe what we've done in the way we've written our rules is we've sort of split our society. And we often hear the discussions of the haves and have-nots, but in many ways, we've done that with our financial rules. We heard the comments earlier, 118 million American, or 318 million Americans, and only 7 million can actually, invest with you right now.
Yeah.
And we treat the other 300 million of our brothers and sisters as sort of a second-class citizen in their ability to participate. And I know there's often fear of if we move to an equity-based crowdfunding, but at Indiegogo, you've built fraud detection technology in your platform. Can you share some of that with us?
Yeah. So when we started Indiegogo, it was very important to us to stay true to our mission, which is to empower people to fund what matters to them. And in order to do that, we needed to be open and not curate. So we don't just pick and choose people to be on our site. We don't pick and choose who we promote. That's all done meritocratically. So everyone has an equal chance of success. So with that, though, when you're an open site, you're open to people potentially taking advantage of the site in a way that it wasn't intended. And so we've been aware of that since day one. And over the last 5 years, we've pioneered and innovated around that risk specifically. I actually remember the day when I was trying to look for any regulation that existed to follow, and there actually wasn't anything out there. I didn't fit into any specific box. And so I said, well, let me just pull from best practices of adjacent industries, and let's go at it. And so what we ended up doing was really trying to understand where fraud could come from. And over the last 5 years, we've built a system to fight that. So we really fight fraud in 3 ways. The first is easy. It's the natural dynamics of crowdfunding are a natural deterrent to fraud in and of itself, because when you're raising money from a lot of people, you need to convince a lot of people to give you money. And we know successful campaigns start with the people that they know first. The early funders in are always the people that know you the best. And then through crowdfunding, you can amplify it beyond that to strangers. So that's just the natural way that crowdfunding happens is a great way to prevent people from going on the site and trying to raise a bunch of money for something that doesn't really exist. The second way is our fraud systems that we've built. We've built proprietary fraud detection and trust and safety systems that is constantly learning and evolving, because we're applying machine learning and all kinds of the latest in data science to get smarter faster. I probably say that one day our system will probably be better than any, and it is better right now than any manual process. And then the third is we just follow other platforms like eBay and PayPal. We use a community policing site, a community and policing approach where people can flag campaigns if they look suspicious. But that's 3 layers on top of each other that has kept our fraud rates far below 1%. And it's enabled us to keep this open and platform and really provide a meritocratic place so that we're not judging and picking and choosing who has the right to raise money, but the world does.
And I want to touch on that one bit, and then I have one quick question for Ms. Sullivan, and then we'll pass to Ms. Clark. Less than 1%?
Far less.
And is that, that somewhat surprised me when I came across it, because you allow almost anyone. I mean, I think you have something up right now to save a horse and to fund a bakery. I mean, you have to buy an ad. I mean, you have everything from business ideas to social ideas to, save a large animal.
Yeah. We just said, because of everything going on in Turkey, just 3 days ago, 3 Turkish Americans were so bothered by what's going on. They put up an Indiegogo campaign because they could get started right away, and they've raised almost $100,000 in just the last 3 days to buy an ad in the New York Times to help change the conversation about what's happening in Turkey.
Which surprised me because, from the mechanic of, you are so egalitarian. And I can put up literally anything if I make it through, but yet you seem to have very, very little bad actors.
Because we pull it down ASAP, like right away. It's all automated and systematized. So we catch stuff faster than any human being can do because we're a data-driven Silicon Valley type of startup where we rely on data and analysis and machine learning to catch all that stuff. So, and we're going to continue to evolve there. We're going to continue to innovate there. And I guess the point it's probably worth mentioning is that we did that not because we had any law to follow or any regulation that we had to abide by. I was in fact looking for those when we were just starting 6 years ago, but because, again, we were creating a new industry, we didn't fall into any boxes. But the reason we did it, though, is because we wanted to stay in business. We wanted to have a safe and clean site for our customers because we knew that the 99.9% of people who were coming to our site to use it in the way that was intended would not want to come to our site if they saw or had fraudulent activity. Plus, we didn't want to lose money because if there is fraud on our site, we pay for it, not our customers.
Thank you, Danae. Ms. Sullivan, now you're sort of the unique one here in what you're doing, because in many ways you're actually a small entrepreneur micro-lender. Help us understand a little bit on that same sort of discussion of how do you maintain your repayment rates, because in many ways when they repay you have the opportunity to invest in the next little business and growing concern. I mean, how have you built that model to keep it going?
Yes, that's a great question, Mr. Chairman. I think there are 2 components to that. One is certainly in the screening process, and Acciona is our partner over decades of microlending. They have developed a successful system of screening potential applicants for those who have the credit score, the drive, the passion to really succeed in their business. One of the facets that's unique to what we do is that, unlike a bank, if a person with a great idea and a real drive and passion to succeed in starting or growing a small business is not qualified for a loan at that point, we will work with them through Acciona to help the entrepreneur actually become loan ready. So unlike a bank, you're not told yes or no, you're told not yet. And we're able to actually help those folks who are really dedicated and willing to stay with the process, stick with it until they are able to get their loan. So there is a very robust screening process in the beginning that Acciona has piloted. Some of that does involve intangibles, like the person's character and how much drive and motivation they have, which we find is actually quite helpful in looking at a business. It is a small business is not just what can be found on the paper. It really is the person, the entrepreneur who's behind it, that in many ways is going to cause it to succeed or fail. So we do have a robust upfront process, but I would say even more importantly and unique to that is the coaching and mentoring that we offer. As many entrepreneurs would tell you, the day that they receive their funding, they look at themselves in the mirror and they think, now what? So for us to be able to work with those folks who have a wonderful idea, a great product but are not expert in the other aspects of running a business, such as sales, for example. You could have a wonderful product, but if you are unable to convince a retailer to sell that product to customers, then you are not going to succeed. So we work with them hand in hand in any aspects of coaching or mentoring that the business owner needs to succeed by pairing them up with Samuel Adams employees who have that expertise. So if you're in Brooklyn, and we have several beneficiaries in Brooklyn, and you would like to work with one of our sales folks in New York City to coach and mentor you as to how to sell your product to retailers in New York City, we make that available to them, and we have found that it has worked. I mean, we have been able to partner with many of the entrepreneurs in selling their products into the smallest of the small neighborhood grocery stores, all the way up to wonderful chains like Kroger and Whole Foods, for example. So they may have a wonderful product, a great idea, the drive and the passion, but what we give them are some of the skills such as selling or hiring or procuring ingredients, things that are very difficult sometimes to attain on your own.
Thank you. Ms. Clark.
Thank you, Mr. Chairman. And this panel has really provided some fascinating information in today's hearing. I just wanted to sort of go down, and because each has such a unique way of going about providing these opportunities, and start with Mr. Cremades. It's been estimated that only 3% of accredited investors are investing in startups and small businesses. In your opinion, is the lack of participation the result of current SEC regulations, the inherent risk of startups, or something else entirely?
With all due respect, I would like to argue that point. From 2011 to 2012, the angel investors in number increased 59%, from 200,000 to 318,000. And also, I would like to say that the amount that has been invested has also increased 43%. As a matter of fact, it went from being a $15 billion market, really angel investors investing in startups. It went all the way up to 22.1 billion in 1 year alone. And in addition to that, I would like to say that people are, especially investors, disappointed with the returns that they're seeing on the public markets. Really investing in startups, obviously, is risky. But especially these individuals that are high net worth individuals, for them, just really putting 8% of their portfolio into this type of investments, it really is not that much. I think that not only you are investing in a company, but also you are being part of something. And that's the most important part of this. So back to your point, I would like to say that times are changing. I think that people are slowly getting educated at the same time, and the industry is definitely growing from every perspective.
And just as a quick follow-up to that, do you believe that it's important that new regulation and policy be driven by the practical application of what your investors are doing? Because this is sort of uncharted territory, which is why you're, I think, running into the obstacles that you've seen. We're trying to fit your model into existing frameworks that really are not applicable. What would you say from your vantage point would be a good approach to, I guess, unleashing and creating the space for the development of the model that you've established?
Yeah, so for us, we don't rely on what's going to happen with the Jobs Act, on what the SEC is going to come out with, if they're going to have a special vetting mechanisms that are going to apply for the crowdfunding industry and the platforms, the funding portals that are going to be operating. We do strongly believe that platforms, especially now at this point, they should all take reasonable measures and also responsibility and accountability for developing the appropriate systems so that they can provide the best services for the angel investors and also for the startups, and in the end really somehow contribute to that investor protection. So as a matter of fact, on Rock the Post, and it was funny that we touched on this point earlier, we also do have identity verification systems and social proof mechanisms that help to conduct the due diligence better between the entrepreneur and the investor, and we do backgrounds on every single individual. So I do believe, back to your point, that it is important for the platforms to take accountability and not to rely on the public institutions.
Thank you very much for your response. Mr. Miller, investing in a small business can be very risky. Even the most sophisticated investors occasionally make bad decisions, losing their investments in the process. Easing SEC regulation and reporting requirements for crowdfunding securities as required under the Jobs Act will therefore expose tens of thousands of investors to increased risk. In your opinion, how can the SEC adequately inform ordinary investors of the risks while not burdening small businesses and restricting access?
So what surprised me and what we've been doing is that a lot of large companies, in real estate at least, have started doing what we're doing. Using Fundrise, we're working with Forest City, which is an $11.6 billion company. Based in D.C., you see basically most of the major real estate companies now starting to do this, and the reason they're interested is that they want the public as a partner. There's enormous value, social value, in having the public get activated, be part of building their neighborhood, in helping you make better decisions. You get better data. When you go to community meetings, when you go through the entitlement process, when you go to get maybe your liquor license, you have a more representative support for that project. And so I think that the idea that crowdfunding is only going to be small businesses that are risky is actually a misnomer. I've really seen a huge diversity of players interested in using this kind of new tool, this sort of new innovation that makes it possible to create sort of an equity in who's building your city, who's investing in it, sort of who owns your environment. And so I think that, and what I've seen also, and I think everybody here is talking about this, it's our lifeblood to make sure that there's quality offerings on the platform. I mean, it's a disaster for there to be, fraud or even failure just from normal entrepreneurial processes. So, everybody is focused. Anybody who's building a platform, investing millions of dollars, is going to be focused on that, and I think has a deeper expertise, for example, in real estate or underwriting breweries, for example, than maybe the regulators do.
So just to follow up to you, can you elaborate on the challenges that you have faced with traditional capital with regards to these emerging neighborhoods that you're applying your technologies?
I mean, I take a perfect example. There's a developer in LA. He's bought a 450,000 square foot project in downtown LA, and the institutional capital partner said, downtown LA, we don't want to invest there. It's tired. It's really not the future. And he couldn't raise capital in a normal place, and he basically ended up raising it from a hedge fund. His cost of capital was double, triple, really what it should have been. And so this problem, and I'm giving that an example of this is a problem that institutional capital is making with small businesses and making with large businesses. They just don't always understand the dynamics of growth in neighborhoods. Usually they're not local, and so to them, Bushwick looks the same as Williamsburg. It's like, oh, that's like the same, right? But if you live there, it's a joke, right? So I just see that crowdfunding is really a way. Over time, you'll see that there's a partnership between institutional capital and the crowd. I'm already seeing it with big companies coming together, and that's how you'll see kind of a new sense of like, why is this like, there's decent underwriting and security? Well, because there's institutional players involved. It's not an either or. It's really going to be about both.
And then, Ms. Sullivan, I wanted to ask about this program. Your program is quite unique. I'm familiar with Axion, of course, being from New York, but a larger business, a company like yours in collaboration is a model that we haven't seen heretofore. a larger business providing smaller ones in the same industry with professional coaching as well as an opening doors to lending opportunities is quite unique. How has the program been received by the food and beverage industry, and has there been interest in replicating the model elsewhere?
That's an interesting question. I don't think the answer is yes yet. I wish that were true. We would say that the notion of funding those in your industry, other food and beverage companies, is really where we can add the most value. I think sometimes folks will look at them as potential competitors. But from our perspective, our sector, the craft brewing industry, is only 6% of all beer sales in the U.S. So we believe that there's room for, many other small brewers to come in and join us as a small brewer. There's still so much potential growth. We welcome others to the table. I don't believe that really this notion of bricks and mortar businesses like ours funding others in their space has caught on to a great extent. I'm aware that Tory Burch, who is a fashion designer who designs clothes, has been funding other sort of upstart clothing designers. She actually partners with Axione as well. To my knowledge, we're really the only two manufacturers who are funding other manufacturers in their same space. I would make the case that that's a missed opportunity because we are much better able to provide what I believe to be one of the more critical components of the program, the coaching and mentoring, to people who face the same challenges that we face currently or have faced in the past. For my ability to coach somebody in the real estate industry, for example, is much decreased versus what I can talk to another beverage manufacturer about. So I would say that there is a competitive notion that keeps others perhaps from funding or mentoring upstarts, but I also believe there's a huge opportunity there.
Thank you, Mr. Chairman. I yield back.
Thank you, Ms. Clark. Ms. Chu.
Mr. Crematas, can you describe the process that both small businesses and potential investors must go through in order to access crowdfunded capital through Rock the Post or similar portals? What are the terms or obligations that must be met either as a small business or as an investor?
So right now that's a very good question. Right now we are operating via Regulation D, Rule 506, and we do this in compliance with a broker-dealer. And the name of the broker-dealer is called Bendigo Securities. And this firm was founded by the former CEO and CFO of E-Trade Financial. So essentially what we do is we aggregate the issuers and also the investors, and then they get to do what they do best, which is the back-end compliance of the transaction itself. So essentially for the compliance, there is a lot of paperwork that needs to be done before putting an offering on the site. On average, last month, I believe we received over 1,300 startups, and unfortunately, since the due diligence is quite heavy on every single one of them, it takes normally on average between 2 to 3 weeks to make sure that we can drill down on the terms and also the structure of the company. We can't take all of them. So it's hard for us really in that sense, no? We have, basically the process is that we receive the application from the company. Once we receive the application, then we focus on the team, the market, and also the product. And if we're able to see a compelling story, potentially something attractive, then we would pass along the application to our investment committee. So our investment committee is comprised by 4 individuals. They have over 30 years of experience in the financial service space. They're all professional angel investors, and they also have over $2.5 billion in acquisitions under their belt. So they are the ones who really take care of the back end type of the transaction. No, that is conducted essentially by Bendigo. So once everything is met and all the criteria is in place, then we will go ahead and host the offering on our site, and automatically it becomes available to the accredited investors that are registered on Rock the Post. So that's essentially the process.
And once the SEC issues its regulations, is this going to change the investing process?
Well, obviously, there's going to be a lot of disclosures that are going to have to be done with the Jobs Act. I believe many of you have taken a look at what Title II and Title III really introduce. And there is some heavy obstacles. Like, for example, if you're raising over $500,000, you need to do a audit report of your financials. I think that for being a startup, that's quite unacceptable because it's over $50,000 potentially that you're going to have to pay on that. So I think that there is many things in the Jobs Act that need to be shapen up a little bit further, because I think that even though the regulators did a fantastic job in putting that out there, I think that they need to really be a little bit grounded and establish friendlier terms to companies that have been in business for a very short period of time.
And what type of small businesses seek investments through your service? And what kind of investors are providing funding? And are there certain communities that are benefiting more from crowdfunding?
So we focus on high-growth companies. So it's essentially the tech space, the healthcare, hardware, and also consumer. So those are the type of verticals that we cover. Essentially, we try to focus on businesses that are going to be able to potentially have a liquidity event in a frame of 5 years, so that the investors can get their money back. And that's kind of like the aim that we're going for with Rock the Post.
Okay. And for anybody in the panel, how do your companies reach out to small businesses that are not as technologically savvy or equipped? How are you able to get those? I mean, what are you able to offer the investors in return for the contribution of funds?
In terms of getting the word out about Samuel Adams Bring the American Dream, we find that the old-fashioned way works very well. We actually have teams of volunteers, both Sam Adams employees and Axion employees, who do what we call block walking, and they will go from business to business and give in communities and spread the word about the program. We also spend a lot of time letting traditional investors such as community banks know about the program. So when they are unable to fulfill a funding request for an applicant, they're able to give them an alternative and let them know about our program. And we also work with local governments. So we find that many of our applicants hear about the program through a mayor's office of economic development, for example. So we pursue a variety of means, including going out into the communities and looking directly for entrepreneurs and going through other gatekeepers, for example, like the banks, to get the word out. We do still find that there is difficulty in getting the word out. One of the challenges we have on the program is actually letting folks know when they're turned down by a bank that there are other means of financing out there. So we also do call on social media and the traditional media to help us build awareness of the program. We have more money to loan than qualified applicants. So we are looking for qualified applicants. We have capital right now that we would like to have out to these businesses, but nobody has applied for it.
We use classic marketing tactics from online social media to speaking at events to giving workshops and webinars and education about what crowdfunding is all about. But one thing I should mention is that, at Indiegogo, we are very excited about equity crowdfunding. We don't offer it right now. But as we look at it and assess it and figure out how we can actually do it and offer it in a safe way, we would be looking to maintain our ethos of being an open and democratic and meritocratic platform. So unlike other platforms, we probably wouldn't want to have a gatekeeper involved. We wouldn't want to have a team of people deciding which people have the right to raise money or which don't, because inherent in that is bias. And that's where you run into things like we had a campaign that raised over £110,000 in London for a project called the Cat Cafe. This is a cafe where you go and you have coffee and you hang out with cats. I met a banker who said, that's the craziest idea I've ever heard. I would never loan to that business. And I said, well, £110,000 worth of funding just went into it from the people because they clearly want it. And so because of that, he said, wow, I'm clearly wrong. I missed that opportunity. And so when you have a system that is relying on gatekeepers, individuals picking and choosing projects, you inherently have bias. It's why it's also not surprising that on Indiegogo, Or sadly, in the venture world, only 3 to 8% of all venture-backed businesses have a woman on their executive team. If you go to small business, 40% of small businesses are run by women in America, which is a much better number. If you go on Indiegogo, 47% of all successful campaigns are run by women. That's the power of a meritocracy and democracy. And so if you require us, for example, if the regulations were to come out and you require us to have a person sitting there reading applications, that inherently would be against what we believe in. And so that's we didn't know that when we got started, but in being able to innovate and being in a regulatory environment that allowed us to innovate, we were actually able to come up with a system that's far more fair and far more efficient.
So I would like to, can I add something? Yeah, so I agree with Danai. I think that obviously having a gatekeeper is not the best way to democratize, the access to fundraising. But, of course, for us as a platform, we want to keep the business open. And if we wouldn't have that gatekeeper, then the SEC would come after us, and then we would be in trouble. Obviously, once the Jobs Act is implemented, we hope that we can explore other ways in which we could, have the platform up and running and basically provide the same opportunities to everyone, because that's the main reason why we decided to put this platform in place when we founded the company in 2010. But obviously, right now, to be in compliance, we need to have a gatekeeper so that we make sure that everything is kosher once it hits the platform.
Okay, thank you. I yield back.
No, thank you, Ms. Chu. And actually, a perfect question, because they're actually, I'm going to yield myself a couple moments here, and we'll let's consider this the lightning round. But that's actually been one of the discussions, is maybe if I'm the public and have a couple $1,000s, but I want to put it into a business, maybe I look for a platform that puts up an opinion or has a gatekeeper. Are the others something much more egalitarian, where it happens to be my area of interest or my geographic or neighborhood I know? As we move towards, hopefully, having the SEC, sorry, I don't mean to be sarcastic. I have faith the SEC will get us our rules set, and we at least understand the box we're operating under. And if those of us as members of Congress need to, sort of do a Jobs Act 2.0 to fix any things where either from our drafting or their rule sets to make it work. If I come to you tomorrow and say, we have equity crowdfunding as you believe it's coming, what changes? What are you, as Indiegogo, about to do different? How will if I go on the site, will it look different? Will my mechanics be different? What am I going to see that comes different once you can actually legally do equity crowdfunding?
Well, the moment it becomes legal, that's when we actually start to get to work and we start experimenting. So you won't see anything new, different, because everything that we think customers might want, whether it's the certain information that they would want back in terms of reporting or rating systems, all of that, that's all hypothesis right now. And so as an entrepreneur, it's my job to put on the lean startup hat and not make any assumptions, just come up with hypotheses and then go prove it. So what we probably end up doing is trying to replicate our approach to crowdfunding, perks-based crowdfunding, with equity in a very manual fashion, with maybe a few customers here and there, and really dig into those experiences and learn what both the campaign owners need in terms of help, support, education, features, product enhancement, whatever that may be, as well as what funders would need. I think it's very easy, and this is the hardest part about setting regulation, is that this industry doesn't yet exist. And the regulators are tasked with coming up with a regulation on how to control it, but clearly the risk is too much regulation will completely stifle innovation and not allow customers to actually, for us to actually explore what this new equity crowdfunding experience is supposed to be. So nothing would actually change for us. It would just be far more experiments and learning so that we could actually come out with something a little bit later.
Thanks, Danae. Mr. Miller, same question, and you and I had also had the discussion of would you even move to equity crowdfunding as it is in the Jobs Act, if that regulatorily, mechanically would benefit you, or are you staying with the model you've developed now?
Well, I mean, assuming that the regulations are manageable, we definitely would embrace it, because one of the challenges is that we get people from all over the country, and I was talking to a developer yesterday. He's in I don't know, Kansas, and I never heard of him, and turns out he owns 24 million square feet of real estate. And so it's just striking how, at least in real estate, it's very, very local. And every local market, if you understand your local market, and you're really not going to understand the next one. So if we could actually open it up tomorrow and have really what would be an open platform where people in the neighborhoods actually are saying, yes, this guy's got a great reputation, we want to make this happen, we can push this. We wouldn't have to be having to figure out this sort of top-down approach that really is difficult in a scaling environment. We just have so many people, so much interest, and if we could basically, as I said, I have lots of real estate experts, real estate analysts. Actually, a huge part of our user base are real estate people, and so making them a partner and figuring out, who should get the resources, the limited resources we have to actually, get into the depth of underwriting a real estate deal. So I would actually have an open process in the beginning, and at some point, winnow down when I see enormous support for something locally.
Mr. Mahdi, same question. If you had the Jobs Act at the crowdfunding portion, the rule sets through the SEC, and I'm an unaccredited investor, but I know and like one of the companies. How do I now interface with you? How does your platform now change? Because you are right now designed actually for, you have both a gatekeeper model and a model that only allows, let's face it, accredited, wealthier investors right now.
Yeah, so I think that right now it's really hard to know what the regulations are going to be looking like. I think that there is many assumptions that are out there, but I do believe that, strongly believe that too much investor protection, and I'm a big fan of investor protection, would kill the attractiveness of the industry for platforms like us to switch to the funding portal perspective rather than being operational via the regulation D Rule 506. What I do feel, and I'm particularly very excited about, is the possibility of adding social media, blending social media with platforms like ours, because it's definitely going to be able not only to give more exposure to these ventures, but also to provide much more transparency. Yeah. Because I think that's the beauty of social media, is that it's that process of being able to crowdsource a due diligence process with a vast amount of people. So I'm very excited about that.
Bless you. You hit one of my personal fixations, and that is sunshine information from lots of different sources is the ultimate regulator, because many of us here, we turn to the SEC and think they're going to know everything, and that's impossible. And that's how we have some of the small and huge frauds with highly regulated entities. How do they get away with it? Well, there's not enough information in a central place where we as the public, we as, even the regulators can actually see it. Yeah. Our discussions about, affiliated blogs. Mm-hmm. And I'm sorry, but does anyone else do this where you go to the Consumer Reports of the blog, and the first thing you do is you look for the negative report, and you start from there and go backwards?
Mm-hmm. Yeah, I was speaking to the former head of risk at PayPal, and they said the best thing that's ever come along for risk management in the financial industry is social media. Because it's identity management, it's track record management. When people have a social footprint on the web, you have a ton of information you can look to assess risk, and all of that information goes into all of our fraud algorithms. So that's why I think bringing social media together with investing is incredibly powerful. We did it with perk-based funding, and I think that's honestly why we've been so successful in keeping the site clean and safe.
All right, Ms. Sullivan, just as a one-off aside, are you ready to have a relationship with Indiegogo to actually raise some social entrepreneur money for some of your small startups? I see a love connection.
Yeah. We do have beer companies on Indiegogo.
Well,
That'd be great.
But because mostly you're micro lending, mm-hmm. But at some point, but your loans range from what's your smallest to what's the biggest you've seen?
$500 up to $25,000.
So once I got my $25,000, I started going. Could you imagine a future where you might actually move them on to, you need the next tier of capital to actually really start to grow?
Yes. We actually find that with our small business owners, Some of them do come back and apply. We've had folks who've taken a second loan and a third loan, which they're certainly eligible for. We actually have found many times that the capital that we're able to grant them has allowed them to grow and create a track record that then makes them qualified for traditional lenders. So many of the entrepreneurs that we funded 5, 4, 3 years ago have had enough success using that capital. They've been able to then qualify to get bank loans, which they previously had not been qualified for. But I would love to talk more about that. I think the notion of getting consumers, we've involved consumers in our program as donors to the loan fund, but you're way more expert in doing that than we are, so I'd love to entertain those conversations.
Bad habit if I
Yep.
can't put a deal.
Well, with your form of lending and with crowdfunding, what's really incredible, I didn't get too much into this into the testimony, but the market validation that comes from people voting with their dollar is incredible. A great example of this is we had a campaign owner that was raising money or had developed a light called the gravity light, which is this really innovative light where you raise it up for 30 seconds and that creates 30 minutes of light. It's a great solution for the developing world where kerosene is the go-to lighting source, which is dangerous and expensive. And so this entrepreneur was really excited about this design. He spent weeks calling venture capital, big banks, trying to get them to take interest and give him some startup capital. And none of them would return his phone call. So he then went on to Indiegogo, raised $400,000 by pre-offering lights in exchange for $10, $20, $50. Guess who wouldn't stop calling him? All those venture capitalists that originally would never return his phone call, because clearly the fact that he was able to raise that much money from the crowd was validation that there's market interest. And so he gained the confidence, he gained the customer feedback, he gained the validation that he's onto something, and actually he gave him power now in the situation with the traditional investors. The reason why the traditional investors aren't complaining about it, though, is that their investment now has been completely de-risked. The big job of traditional investors, whether they're VCs or banks or foundations investing in nonprofits or even government and labels and studios trying to find the next artist, they have two big jobs. One is one of gambler, essentially, try to pick the right idea or person or entrepreneur to back. And then the second job is to amplify them. So if they're lucky enough to roll the dice and get lucky with one, then they come in and put more money in and grow them. So what crowdfunding is doing is creating this incubation platform, kind of almost like a farm league for the major leagues, if you want to think about that, where the majors are traditional investors, where the cream rises to the top, not based on a lucky connection, but truly based on how hard the campaign owner is working and how much the audience and community cares, which is, we think, the only two factors that should matter. And they rise to the top and then get discovered by the more traditional financiers who can not roll the dice on them, they've proven themselves, but come in and just focus on their amplification job. And so that's why I think crowdfunding and these creative alternative forms of financing it is truly American. It's really empowering people to go after their dreams and have control over themselves and their own futures and not rely and hope that some third-party gatekeeper will say you're good.
Ms. Clerk.
Mr. Chairman, I really don't have any further questions, but just to say to our panelists today that you've kind of renewed my faith in the capacity of our nation to sort of remake itself from a capitalist standpoint. So much of what we experience here in Washington is from the macro perspective, and that hasn't been a fun ride recently. But what you're doing is remaking this in a way in which it's much more democratic. I'd be interested in seeing how each of your endeavors is translated into future generations, how other young people see this as a new discipline and buy into it. Because, of course, the predominant model is the traditional model, and many communities don't have access to that. Having the platforms that you all have makes it much more available, and I hope that we can see some new schools of financing thought come from it. And I wish you all well in your future endeavors. Thank you.
Thank you.
Yield back.
Thank you, Ranking Member Clark. As we get ready to shut this subcommittee hearing down, look, I'm have grown to become an absolute believer by literally the end of this decade for small business and maybe even mid-sized business. The way we find investors, the way we capitalize our organizations is going to look different. And much of this is embracing the technology around us and the ability to capture information as that sunlight, as that refiner of concept and also eliminator of fraud. Because so often what happens here, my experience both previous 2 years on financial services and here, is our terror of fraud, the terror of someone losing money in a deal, means we take a huge portion of our society and our population and say, you don't get to participate in receiving a rate of return, even though you desperately need that rate of return to have a future, because we're terrified that someone might lose money. And that ability to take risk is also the ability to grow. It's the ability to have a future in our society and for all populations. So what you're doing is incredibly important to us. I'm going to ask you, if you have ideas or you come across information or you even hear a rumor coming out of the SEC, let us know. Because this subcommittee and I think the committee in general, we're watching very closely, hoping that the SEC puts out a fair, rational, workable rule set. For a lot of us, it's spent a lot of time over the last couple of years trying to put together those elements of the Jobs Act. So I have faith this isn't the last time I'm going to see the four of you, and this has been very interesting. And with that, I'll ask for unanimous consent, which I guess that means just you and I, that members have 5 legislative days to submit statements, supporting materials for the records. With that also may come some questions being extended out to each of you. And if you have the ability to, with the chaos of your lives, to send us back a response, that's truly appreciated. And without objection, so ordered, this hearing is now adjourned. Thanks.